Okay, it's Race Robinson, your favorite Florida mortgage broker, and man, I go on vacation for 1 week and rates go crazy. So we're gonna look at what rates are doing, why that's happening, has anything majorly changed. And I found this really interesting article from Fortune magazine that looks at what all the big dogs are saying, from Fannie, Freddie to Zillow, which I thought was really interesting, and how hard it is to actually predict the market. But if you look right here, you can see rates right now, Mortgage News Daily saying 6.8%. It's a site, remember, every situation is different. There's all kind of different ways to get rates, but I like to look at this as a general gauge. So 6.8%, and even they mentioned in this article here that it was exactly 2 weeks ago, February 2nd, that the average lender could offer 5.99%. The same lender today would be closer to 6.75 to 6.875%. Wow, is that a big change in just a couple weeks? What's changed? The big thing that's driving rates one way or the other is the market pricing in inflation, recession, and all of these things. And the Fed is talking tougher because the PPI report, which was inflationary at this last reading, and then the jobs report. To make a long story short, the market all of a sudden looked like there could potentially be more inflation, and it doesn't like that. The Fed is talking tougher, and so that is driving mortgage-backed securities, which is also driving interest rates higher. So what it needs to happen. So the market has to believe that there's going to be higher unemployment, and also that there's going to be a break, right, with this inflation, that we are going to continue to get a step down in inflation. I found this cool article from Fortune magazine where they talk about housing market again wants braces for higher mortgage rates. They kind of say here the 6.8% mortgage rate is the highest reading on Mortgage News Daily, which we just looked at, since early November. It also means affordability, which is the big thing, right, that is starting to decrease. And if you look right here, this is where they kind of spell out what all the big dogs, as I call them, or like to say, are looking at. So Mortgage Bankers Association, they're predicting, look at the difference in these predictions. Mortgage Bankers Association, 5.2%. Bank of America, 5.25%. Now we go to Fannie Mae, 6.3%, 5.7% in 2024. Freddie Mac, their counterpart, pretty much the same thing, 6.4%. Moody's Analytics, which is very solid in some of their predictions, 6.5%. Goldman Sachs, 6.5%. And Realtor.com coming in at 7.4%. What does that mean? One, it means the hard thing with rates is not just that the payments are higher, right? Because that's obviously what people buy on, but it affects affordability, meaning that most people tend to buy to the edge of their ratios, and of all these clients or borrowers of ours are now qualifying for less, that means they have less purchasing power, which means since housing prices aren't really falling, some areas they are, especially out west, but in general, housing markets have been fairly stable in a lot of the markets, for here, for sure in Florida, then all of a sudden they can buy less house. And that's really the big issue because, if they can afford a 380 house, but now they can only afford a 340 house, maybe that puts them out of range of being able to buy a home. So that's why rates are so important. So what does my crystal ball say the rates are going to be by the end of the year? Well, as I always say, my crystal ball is in the shop, but I will say I spent a lot of time looking at the market, and I listen to people other than the big dogs who I think actually look at a lot of more nuanced information, not just headline clicks. And if you look at the way they change the way they're calculating CPI, the way rentals, as far as the rent, meaning that people have to pay for rent, is coming down, on some of these other things that are calculated into CPI, I really see still rates being under 6%. So I'm definitely more in that optimistic camp. But unfortunately, in the short term, call it the next month or so, I think you're going to see rates pegged in that 6.5% to 6.8% range. Again, no one knows for sure. I'm really thinking after the first quarter, beginning of second quarter, we're going to start to see this slow decline in rates, which will help everything, especially as we get into the summer. Again, no one knows for sure. We'll keep looking at the data. With that, make it a great day. Call me for anything. Talk to you soon. Bye-bye.